Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts. Phil and I back again, and this time we're going to spend some time on RMDs because they're confusing to a lot of people. Most of us, Phil, know what RMDs are, so we'll do it real fast just to kind of clarify. But I really want to kind of break down some information a little bit further.
And it's something you don't want to mess up. So
yeah,
I'm doing good, doing good. Love a summer. So
yeah, definitely. And that's a great point. Something we don't want to mess up because it's hefty. You know, we've talked about that. That's like the high level stuff we've definitely covered before, I think, in past episodes. But I really just kind of wanted to spend some time on helping folks understand this a little better because there is a lot to it. And, you know, you guys get questions around this stuff all the time. So I thought, hey, this could be a good way to go. Did you enjoy your trip, by the way, before we get started?
Yeah, it was good. Yep. It's always good to get away. Our 2-week camping up in Higgins Lake. So
nice.
It was nice. Very relaxing, which is exactly what that vacation always is. So.
That's the point, right?
Yep.
Then you can come back and talk about RMDs.
That's right. Dig back into it again.
That's right. All right. So let's talk. We're going to break this into kind of two major pieces, I suppose. So RMD on your own account will be one. And then RMDs on inherited accounts will be another. So
two totally separate rules. So
two separate rules, right? So let's start with our own accounts. As I mentioned, many people, Phil, know that the RMDs were moved from that goofy 70.5 to 72, which was great.
At least it's a single year now, not a half year. So
it's a simple number. You're not now figuring out the weirdness of your birthday.
Was I born in June or July? Or
right. Exactly. So this was changed in 19 at the end of 19, like really at the end of 19.
Right.
Going into 20 with the Secure Act. So break down for us a little bit about the RMDs and on your own account.
Right. So it's, again, the new rules are if you were not 70.5 by December 31st of 2019, then now you flip to the 72 is your RMD age, so if you were, unfortunately, were 70.5 by that December of 19, you're under the old age and that's, you had to start with RMDs. If not, you're now 72. Yeah. So, and that's pretty basic. That's really how it works for IRAs. IRAs, SEP IRAs, simple IRAs, all kind of fall within one.
Right.
Qualified plans, so like 401ks, 403bs, they're a little bit different. It's going to be that RMD age, the later of that, or your date of retirement. So if you're still working for the employer, and it's only the 401k for the employer you're working for, and that's key. It's not all 401k. So if you've retired and have some old 401ks that you haven't rolled over, that's a whole nother discussion we should have. But if you have that, those you would still have to take RMDs on. But it's only for the current employer unless you're more than a 5% owner. So, I mean, if it's your company and you're still working, then even though you're still working at that RMD age, now you have to take RMDs. So the IRS knows the game. It's like, well, okay, you control the company. So, you can't continue to work, quote unquote.
Yeah, I didn't even think about that.
I was avoid the RMD age. So
that's a great point. I'm glad you brought that up for our business owners that listen to it because many times people kind of think about it. Well, okay, I work for the company, I'm at Ford or whatever, or GM or something I've got. And I also noticed that it's a little known thing there that it actually the same rules that apply to RMDs, which again, required minimum distribution. You have to take the money out at 72 of your IRA because the government's been waiting for 40 years or whatever it is. They want the tax cut. That applies also to Roth 401ks.
Yeah, and that's a little trick that's
a little
caveat, I guess most people don't understand or realize is that Roth IRAs, you do not have an RMD on, but a Roth IRA. 401k or 403b. A qualified plan, if the money is left in the plan, then you do have an RMD on it. Yeah.
So let's clarify that again real quick. So if you have if you have a Roth IRA, RMD rules do not apply because you're paying the tax going in.
Correct.
But a Roth 401k, you do have the RMD rules.
Yes, if it still is in the 401k. So, I mean, the easiest solution with that is roll it out of the 401k into a Roth IRA. Now you don't have that.
Now you don't have that
so
problem.
that might apply. Let's say you have some old 401ks, right?
Okay. All right.
And it has Roth in it. If you leave it there, now you have to take an RMD on the Roth component of that 401k.
Okay. Right.
So it's a great reason not to leave it in the 401k.
Not to leave it, yeah.
Get it into an IRA. Therefore, you don't have to now take RMDs, or you, the owner. And it's a whole nother scenario. You get into beneficiaries, which we'll talk about again in the next step. So.
But I wanted to clarify that little quirk in there as well. So I wanted to make sure we touched on that. So let's talk about the beginning date. Okay. So I don't know, the easiest way, let's just keep it with 72, right? Since that's the rule or whatever. But when do we have to do this by? What's some just specifics around, let's make sure we get this done. Because as we mentioned, it's a 50 penalty, it's 50%.
Yeah, 50% of anything you miss. You don't want to miss it. So the first year you're required to take a distribution. So let's say you turned 72 this year. So technically this year you have to take a distribution. The required beginning date, though, is April 1st of the year following your first year, or the year you turn 72.
Okay, so let me clarify for a second. So just make sure I got people straight. So if you turn 72 this year, so let's say in May, you got to get it done by the end of the year, right? But you have technically until April.
Yes,
so,
that only applies the first year, though.
Okay, and that makes sense, because people sometimes say, "Well, my birthday's in December. How do I get that done?"
Right. So I mean, if your birthday's on December 31st, well, technically you are 72 this year. Right. You have to take an RMD. Well, the first year you have until April 1st. So there's some planning opportunity. We use this a lot with clients, where even if they're turning 72 this year, especially if we're doing Roth conversions, we can delay this year's RMD till next year. Okay. Giving us one more year without an RMD, where we can do conversions and control income a little better.
But then do you have to do two the next year?
Yes. The caveat with it is next year, now you have two, because you have the April 1st distribution that really applies for the previous year and for that year. So 2023, in our case, you have to take an RMD.
Once you get started, it's just annually then.
Exactly. Once you've started it, every year you have to take it. It has to be done by December 31st. They don't care when you do it. You can do January, December, equally throughout the year. They don't really care.
Okay.
It has to be done by the end of the year.
That brings up a good point. Is it a one-time thing, or do you have to just satisfy the total number over the course?
It's just the number. Yeah, you can, however you want to do it. Okay. It is really up to you.
So if it's 10 grand, just for hypothetical, in the course of the calendar year, make sure that you're pulling out at least 10 grand from your IRA.
Correct.
Okay.
Yep.
Okay. So how do they calculate it?
So, and this is again where it gets a little bit quirky. So it depends on the type of an account it is. If it's IRAs, whether you have 1 or 10, it really doesn't matter. The IRS views it as one. They aggregate the accounts, is how you have to look at it. So add up the value of all your IRA accounts. Gotcha. And how the RMD gets calculated is, again, if you were 72 this year, figuring out what your 2022 RMD is, we look at the value of those IRAs on December 31st for the year prior. So December 31st of 2021. And then based on the life expectancy, your life expectancy, we go to the uniform life table, which again was updated for 2022. So distributions starting this year or beyond, they've updated the table. So they extended it. Okay. Meaning they've increased life expectancy, lowered RMDs just slightly. But you would
percentage amount.
Yep, effectively. Yeah. Because the table is a life expectancy factor. It's not a percentage.
Okay.
But then you look at the table, you would take the value of the account last year, December 31st, divided by that life expectancy factor, and that gives you the dollar amount you have to take.
Gotcha.
So in our example, if we had 10 IRAs, personally, how we do it, I've got a spreadsheet we keep on all our clients that we go through and say, well, here's all the different IRAs. Here's the value. Here's the RMD. Whatever that number is, you can take it out of any one or a combination of those IRAs.
As long as you satisfy the numbers.
Correct.
Okay.
Yep. And personally, again, how we manage this is that's why we have our now, soon, and later bucket. So we'll have a soon and a later IRA. We're calculating the RMD on everything, but then taking it just out of the soon, the more conservative IRA.
Sure, that makes sense. Yeah. Okay.
So that's IRAs.
Right. So to kind of keep it simple a little bit again, so we don't have to, as laypersons, we don't have to necessarily worry about calculating that number, right? That's done for us. Is it done for us if we don't have an advisor?
Yes, and it depends, right? So technically, from the IRS's viewpoint, it's your responsibility. It's the taxpayer's responsibility.
Good to know.
Now, that being said, most custodians will provide you a letter, an RMD letter that says they go through the calculation for that account.
Sure.
You know,
for that one account, right?
Correct. So again, you would have to add up all the different RMD amounts, and you can then take it out of any one or combination, or take the RMD out of each account.
Yeah. So
again, the IRS really doesn't care, but
pro tip, another reason to work with an advisor, folks, right? RMDs can get a little sticky, you know. So.
And I mean, the custodian doesn't have to do that, you know, and not all custodians do. The majority of them do. The bigger custodians do.
Sure. Yeah.
Because I mean, if you think of it, they're now taking on some liability if they're telling you, here's your RMD, and it's wrong because, you know,
good point.
IRS can come back and say, well, this isn't the amount, it should be this. And now you can point to the custodian and say, well, you told me.
Yeah. And now with our 80,000 potential new IRS.
That's right. Yeah, the new IRS.
They're going to start looking for every single little thing they can find. So, okay. So that's a lot of times, though, because we do hear something like 4% on average. You'll hear like an advisor kind of say.
Yeah. I mean, it starts off. So 27.4 is the life expectancy at 72. Okay. So rounding it, it's around 4% is where it starts, and it goes down from there, or goes up from there. Life expectancy
goes up from there annually.
Correct.
You have to pull a little bit more each year.
Exactly. A little bit more each year. And that's why RMDs typically get larger, grow each year. Obviously, depending on what's going on in a market and an economy, et cetera, but you're only pulling out 4%. So if you're growing at least a 4% rate, your IRA balance is probably staying the same or growing, and next year you have to take a bigger percentage.
Okay. And so that you mentioned that was for IRAs, but that assumes that's the same thing for a 403B.
So 403Bs are similar, where you can aggregate 403Bs and take it out of one or any of them. 401Ks or other qualified plans are different. Each 401K you have to take an RMD out of. So if you have old 401Ks, you know, you've got 3 former employers, you just left the money there.
Yeah.
Technically, you have to take an RMD out of each account.
Gotcha.
So it just becomes a lot more cumbersome. Again, another reason to potentially roll it into an IRA, aggregate everything together, makes it easier, gives you a lot more flexibility.
But you know what, Phil, that's a great tax hack, right? Or, you know, I mean, that's the name of our show, but that's a great little tip, because if you think about it, like you might have 4 401ks and you're like, they're fine. You know, I'm just going to leave them there for whatever reason. But then this is yet another reason. There's other ones because the fees are typically higher, so on and so forth. So it just gives a kind of a little bit more fuel to say, hey, instead of having to pull RMDs from all 4 of these jokers each year, let's just roll them into an IRA. And even if that's your 4th IRA, to your point, that can get aggregated into one total. So that's a great
calculation set. Yeah. And the tricky thing is with 401ks, the custodians for a 401k are not as likely to tell you what the RMD is. And they don't have to. It's not their responsibility. Technically, again, it's yours as the taxpayer.
Next thing on my notes here is okay, the conversation that we get, hey, Phil, I don't need it. I don't need the money. Maybe I've got a pension from one of the automakers, or, you know, maybe I've got my Social Security. Our plan that we built, you know, has got me in pretty good shape. I don't really need this extra 10 grand. I used that as a number earlier. We'll just kind of circle back to it. What do I do with this 10 grand if I don't want it?
Right. So hopefully you've done planning ahead of time, and we know that. So maybe we've done conversions and help prevent, you know, those excess, what we call excess RMDs, money you really didn't need.
Chop them down earlier if you can.
Right. Yeah. You know, if you didn't do that, and you're charitably inclined, then you might want to do what's called a qualified charitable distribution, QCDs.
Okay.
A couple of caveats with this. I mean, the qualified charitable distribution means it's money that goes from the IRA directly to the charity.
Yep.
And if you do that, it satisfies, number one, the RMD. Okay. So it's not taxable to you.
Or them, you don't, right?
Or them. I mean, it's a charity.
That's true. Yeah.
And you don't get the deduction. Okay. But I mean, in today's environment with such a high standard deduction, most people aren't itemizing anyways.
True. Yeah.
You know, so I mean, if you are charitably inclined, it can be a great tool to use. And we use it with a lot of our clients that even if they maybe need some money from the IRA, but not all of it, you can designate money up to $100,000 a year.
Okay.
And it doesn't have to just be the amount of the RMD. So if your RMD is, to your point, 10,000, but you want to give 20, you can do that.
Okay. Yeah, that's great. I was going to ask you, could you break it up if you're charitably minded, but maybe not that charitably minded? You're
right.
like, hey,
or you can do less. I mean,
so there's $10,000. Can I go 5 to them and 5 to me?
Right. The only caveat is number one, it has to be an IRA. So this rule, the QCDs, only applies to IRAs, not 401ks, not 403bs, other qualified plans. So again, another reason not to maybe leave it there, bring it into an IRA. You got more options. Again, only up to $100,000 a year. For most people, that's not going to be a concern.
Right.
And it has to go directly from the IRA to the charity. So it's not like you can have it go into your account and then you turn around and write a check. If you do that, you're going to get the 1099 from the custodian to report the income, and then you're going to have to take the charitable deduction. So.
Gotcha. Yeah. So no touchy, just set it straight.
Yep.
And of course, they got to be a qualified charity as well.
Exactly. It's got to be a typical, whatever qualifies for a charitable deduction.
You can't set up your own, online church of the whatever. And
right. Sorry, kids don't count. So
yeah, sure. Well, they're a charity case.
They're a charity, but not a qualified charity.
Okay. So as I mentioned earlier, we're going to break this into two, and I should have probably clarified. I meant 2 podcasts because there's a lot of information in here. So the first part, the RMDs on our own accounts, that's what we're going over now. We'll talk about the inherited accounts because it's a little even more sticky. Any other kind of big things here? We talked about the age. We talked about some of the birthdays and how you have that little caveat of moving it up till April, but then you have to do 2.
Right.
We broke down some of the different kinds of things. Any other stuff that we're missing on this? Any other fine little points or little tips we should look at?
No, it's just, to me, really planning around RMDs. Like I said, this is something we work with clients on a lot, and we're planning for age 72. So typically we're working with a client prior to that age. So we're running the math out and saying, okay, well, this is what RMDs look like.
Sure.
All of a sudden you're going to have a, $50,000, $60,000 a year RMD, whatever your number is.
Right.
And if that's more than what you need, now let's backtrack and start doing some planning. So that's where leads us right into Roth conversions and better planning around that to move money out of those IRAs. Because remember, again, the RMD is calculated based on balance in the IRA account on December 31st for the prior year. So if we've done a conversion, we've lowered the balance of that account, therefore lowered future RMDs.
Yeah, another great point there. And I was going to ask you about the 72 thing, as it got me thinking as you were talking. So if we're trying to be effective and do some tax planning, or saying, hey, yes, I do, it does make sense to, let's get rid of some of these 401ks, let's convert them into, an IRA, or let's then take the IRA and convert them to a Roth or whatever. Do we have to do that? Is there a time limit? So let's just go back to that. I'm turning 72 this year. In November. Do I have to get all that done prior to turning 72?
No. I mean, 72, the RMD age just means you have to start taking the money, right?
Okay.
So we have a lot of clients that we've done planning and we're doing conversions even after RMDs. It's just now that we've got to that stage, the RMD has to come out. It's taxable income. We can't convert it. What we end up doing then is we'll use that money to pay the taxes on any other money we're doing conversions in that year.
Okay.
But
I just wanted to clarify.
72 isn't like a cutoff to say, nope, sorry, whatever's there.
You can no longer convert after 72, right?
You can still roll over and combine and take money out of the 401ks and put it into, IRAs, do conversions, things like that. It's just, you have to now start taking required distributions. So it's part of that equation.
Yeah. Until you've reduced that account to 0, basically, you've got to start satisfying those required minimum distributions. And I just wanted to clarify that for those folks who sometimes we get those questions too. It's like, oh, well, I'm 73. Can I no longer Roth?
Oh, there's nothing I can do. No, there's still potential opportunity. It's just unfortunately, now you have yourself locked into this stream of income that we can't do anything about that today.
Right.
So for this year, next year, it's we can start to maybe reduce it over time with conversions, but we now have an extra stream of income, taxable income that probably is going to push you into a higher bracket, all the other factors that go in with that.
Gotcha. Okay. So a lot of good information here on the podcast this week when it comes to RMDs, again, about our own accounts. So if you have any questions, if you need some help, they're obviously they can get a little sticky. There's a lot of great points that Phil made this week about how to maybe kind of unstick some of that, if you will. It is a hefty penalty. So if we do go back to that conversation that I used of, let's say $10,000 is what you owe for the RMD this year, and you don't get it done, then it's the $10,000 plus 50% plus the taxes.
Yeah. So you have to take it. It's not like, I got away with it. No, they catch you. You now have to take the RMD. You still have to pay the tax on it, probably penalty and interest because it's late. And there's a 50% penalty of what the RMD is. So
now let's throw the IRS a bone here, Phil, though, because we all tend to think of them as heartless. You actually can, if you do mess up, there's a form you can fill out to say, I screwed up and I missed it, and they may waive that, but but you have to go through a little process to do that.
Yeah, and typically, as long as they haven't found it yet, and you make corrective action, even without going through the form, you make the corrective action, take the RMD, you're okay.
Yeah.
I personally have not seen a scenario. I've not seen a scenario where the IRS has come in and actually assessed a 50% penalty. They can. That's why, and I don't know if many of the viewers realize this form 5498, which I get calls all the time of, it comes out in May. That's when technically the custodians have to generate it. And they're like, oh, I got a tax form. It's late. No, it doesn't really matter. But that's why that form was required of the custodians and 20 years ago when they started it, because the IRS up to that point had no idea what was sitting in these 401ks and IRA accounts. They didn't know. Yeah. So now they know. And now they have the information they need to calculate what the RMD should be and can start to match that up. Okay. So with this IRS army that potentially is coming our way, I think this is going to be one of the areas they're going to focus on, because like I said, I've not seen any action from an IRS on any client that has missed RMDs. I've had clients that have come to me that our former, custodian or advisor, or whatever, didn't do it, and we've helped them get caught up and get things corrected. Gotcha. Okay. And never heard anything. So.
Well, and that's a good point. So we'll finish with that thought by saying, you've got a $30 trillion in debt and $40 trillion sitting out there in retirement accounts. Yep. What do you think? So where are they going to start looking? There's lots of places they're going to start looking. So again, great topic this week. We're going to do it again next week, but this time we're going to focus on the inherited accounts. So like if you're leaving your 401k or your IRA to your family. So we're going to talk about that next week. So make sure you tune in for that podcast. Check that one out. Again, if you got questions, need some help, reach out to Phil. Stop by the website, philstaxhacks.com. That's philstaxhacks.com. Don't forget that you can, always just reach out to him. Of course, you can find all that information there. You can always call him at 248-888-7530. It's 248-888-7530, especially if you've got questions around this. It's a big deal, so make sure that you're doing it properly. Phil, thanks for breaking it down and providing some tax hacks this week.
Not a problem.
I always appreciate you, my friend. I'll see you next time. We'll do it all again right here on Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.